So let's bring in Alex Coffey, who is the co-host of Next Gen Investing, to tell us what he's watching at the opening bell. A very good morning. Happy Monday to you, Alex. Hope you had a good weekend. Or what are you watching?
Yeah, good morning to you as well. Obviously, kind of a sluggish start, all things considered. Holiday interrupted week last week. Tons and tons of information to be digested by the market last week. But all things considered, still a pretty strong market in terms of the technical picture, in terms of the performance. Now, this week is likely to be dominated, as you've talked about, trade headlines. If you were to look at some sort of technical levels that I'm watching on an intraday basis, this is the last 3 days of trading. We have, of course, drifted higher over those last 3 days, retreating a little bit to begin today's session. The first line in the sand, I would sort of call it more of a neutral line. I like to use the sort of stoplight system when I'm drawing these lines to kind of give us an idea in terms of what we're looking at. This is sort of the neutral line for that. And then to the downside, looking at 62.25. So the first line in the sand, 62.50. Then we're looking down to 62.25. If that were to break, then you could see us, back into that trading range of, kind of late last week, middle parts of last week. So far, it looks to be holding this level. So that'd be the first place to watch. It's around 6,300 for those who watch /ES and prefer the futures market. But Sam, when you're looking at this, it's really going to probably come down to headlines out of President Trump, headlines out of the Treasury Secretary, and perhaps even, stories that come out of, different publications if they feel like they have a scoop. So that's likely to be what drives the action the next several days. And ultimately, sometimes those moves can be swift and also lack staying power, particularly the ones to the downside. So you could have sort of a negative update for tariffs, a rapid sell-off that can sometimes quickly recover depending on, how accurate those statements ultimately end up being and ultimately what those, stories end up saying.
Yes, fascinating, hasn't it? Because the market has sort of shifted as far as the narrative is concerned from what had been somewhat of resilience to a bit of complacency as far as what people are sort of talking about as far as describing the action we've seen. Talk to us about, seasonality, Alex, because we obviously had a shortened trading week last week, perhaps volumes a bit thin on the ground as people sort of headed off for their vacation early. We have earnings around the corner now. So what are you watching as far as that is concerned?
Yeah, so I always preface this with, I'm not a huge believer in seasonality, but there are some parts of the year that are important to pay attention to. A lot of times they're around the quarterly expirations of options, but this one is notable, and this is this first 2-week period of July. Now, I apologize that the chart maybe doesn't do this justice, but the reddish line represents the last 20 years, sort of the average performance of the S&P 500 over those 20 years. The teal or light blue line represents so far this year to date. Now, those who have watched our programming over the last week have probably seen me bring this up several times, and I'll continue to do it. I preface it with, hey, maybe we don't overthink this time of the year. It's holiday interrupted, it's travel interrupted, it tends to be slower, but it also tends to be one of the strongest 2-week periods of any year for the S&P 500. That doesn't mean the second half of July can't change. We saw that happen last year. It doesn't mean that August, September, October can't be disappointing. They absolutely can. We saw that last year. But the first 2 weeks of July, holiday interrupted, heavy travel, lighter time, not a lot of earnings typically, can sometimes lead to this drifting market that performs quite nicely. We're about halfway through that now, and so far it's performed quite nicely. So a couple other notable pieces. We're ahead of the pace of the average year over the last 20 years so far. So despite the massive drawdown that we saw, the recovery, as your last guest talked about being the quickest, it also got us to ahead of pace in terms of if you use the last 20 years as the benchmark. So long story short, don't overthink it maybe. It's a quieter time of the year right now, and it tends to be quite bullish. So absent surprise, drifting up might be baseline.
Yeah, and it's interesting when you look at that green line, isn't it, Alex? Because I heard someone this morning saying that basically if you went into a coma in January and woke up today, I mean, you wouldn't be too disappointed, I suppose. What's the volatility chart telling you?
Yeah, this is interesting, right? Because we hear about all of the uncertainties out there, whether it's geopolitical, whether it's fiscal, whether it's, disagreements between someone like Elon Musk and the president, whether it's concerns about the economy, whether it's interest rates. The laundry list seems endless when it comes to risks for the market. But if you were to look at volatility, which is my final chart that I have for you, it's painting a very, very different picture. It's painting one that's basically say, hey, we're not necessarily back to normal. We're still elevated, maybe off the, the kind of traditional average for volatility. But I would argue, hey, with interest rates well off the zero bound, we probably should have a little bit slighter, elevated volatility just because there's more competition for capital. What you really see is volatility has evaporated, and it evaporated quickly from the peak fears around the end of March and early April, which I think is safe to say is peak tariff fear. That doesn't mean that we're not going to have a sell-off again. It doesn't mean that we can't see uncertainty around tariffs. But what we saw in March and April is very hard to see a second time, particularly from the same cause. So what I would say is the market has become increasingly comfortable with these risks. Doesn't mean they're not real, but that also can be cause for concern, Sam, as it also means we might be setting up to conditions for negative surprise. We're near all-time highs. We have earnings revisions that have come down, and we have volatility low. So again, the message here would be, even though we're in this kind of quiet seasonal time that's generally bullish, you want to make sure that if you're worried about position or you want to, pair things up, you hedge when you can, not when you have to. And what this chart tells me is hedges are a lot cheaper than they were just a few months ago.
Right, and I suppose that's where that word complacency creeps into the market as well. Alex, thank you so much for that and breaking it all down for us. Alex Coffey there.